We are in live, sir.
Okay, thank you. Thank you, Ravi. Good evening. Welcome to the second live session on for the course Foundations to Accounting and Finance. And we are by this time you would have finished the financial accounting part, and you're also into the cost accounting part a little bit. And so this live session would make sense. If you have any questions, I can address it. On the portal where one could post doubts, I had only one question that's kind of common, where somebody had asked me about no audio. Am I audible? Ravi, could you check? Am I audible?
Yes, sir. We are audible, sir.
Audible. Okay, I think I'm audible. So maybe you have to, Manal's section, maybe you could log out and re-log in again to try and check. Am I audible to the others? Ms. Neeraja or Mr. Muhammad Asim? Yeah, okay, fine. I'm audible. That's great. So, Ms. Mrinal Saxena, I think you can log out and log in again. Maybe that would help you. I think the audio is clear for the others. So, that's what it is. And I had one question from Mr. Muhammad Asim with regard to the three scenarios of debt and equity, what I had taken out there. Because I had taken three cases. That was a question that was there. I had taken three cases where I was trying to prove that theoretically debt is a cheaper form of capital as compared to equity, number one. Number two, the risk of the equity holders enhances movement, the debt increases in the firm. If you go back to that example, out here, we saw that we took case A and case B. And each of those cases, what we did was, get the video. Each of those cases, what we did was, we said that there was what do you call it as equity. For example, case A, we said that there is equity of $100. And case B, there is an equity of $60, but debt of $40 out there. And debt carries a 10% interest. That is what we had hypothetically taken out. Both have case A and case B have a capital of $100 each, but one has debt and equity, another has only equity of it. Now, what we took out there is, we said that both A and B have a PBIT, preferred profit before interest and tax, of $10 out there. Now, in case A, there is no interest to be deducted from that because there is no debt. Whereas in case B, there is an interest component there that has to be deducted, and that interest component is to the extent of about $4 because 10% of $40 gets deducted. So what is profit before tax? Profit before tax for case A is the same $10 out there, which is very much here. I have it right here on my tab out here, which is there. And for case B, it is about $6 is the profit before tax. When we pay a tax of 50%, again, hypothetically assume, post-tax PAT, profit after tax, is $5 you get for case A, which belongs to the equity holders of $100, 5% return. Case B, $6, $3 goes as tax, $3 comes back, which belongs to the equity holders of $60, 5% return. If you go back to the video, you can actually see that. But what I did case B was, supposing the firm wants to go for a greenfield project and wants to raise further capital of $20. Firm A raises the further capital of $20 in the form of equity. So the equity becomes 100 to 120 now. Firm B says, I will raise it in the form of debt, not in the form of equity. So what happens? The debt which was $40 becomes $60. It's a green field. So moment it's a green field, the return doesn't happen day one, the return happens over a period of time. But the profit before interest and tax for both of it is same $10. Interest component for A is 0, whereas for B now, instead of $4, the interest component is $6 out there. And post interest, PBT, that is profit before taxes, is $10 for A, it remains the same. Whereas for B, it is 10 minus 6, $4 out there. So taxes are the same 50%. If you look at post tax, what the return what you get is $5 for A. For $120 of investment, $5 is the return you get. For B, if you look at for $60 of investment, the return is only $2 you will get after taxes. So you look at the percentage return. The percentage return for B will be very less. That is, percentage return for B will be only about roughly about 3% or something like that. Whereas it will be around that in that particular case. So what I'm trying to tell you is, when debt increases in the firm, the debt holders continue to get paid exactly the same, and that is also before taxes. All the risk is borne by the equity holders. And that is what I tried to explain with that example of case 1, case 2, and case 3 out there in that particular video. I hope I have conveyed it, Mr. Muhammad. Any other question? Any other question? Ms. Neeraja, Ms. Mrinal Saxena? Have I sort of clarified your doubt, Mr. Muhammad Asim? Thank you, Mr. Muhammad. Thank you. If there's any question, you can ask me. I'm there to clarify the doubts out there. Yeah, about break-even analysis. Break-even analysis, what we talk about is a point of no profit, no loss out there. My cost is exactly equal to my revenue, whatever we say. We talk about two kinds of cost. We talked about fixed cost as well as variable cost. For example, when I say fixed cost is rent for my factory. The rent for my factory remains the same irrespective of the number of units I manufacture. Whether I manufacture 10,000 units, the rent is the same. 20,000 units, the rent is the same. That is what we call it as a fixed cost. The cost does not change. There is a variable cost part of it. Variable cost means the cost which varies with every unit. Every unit I have to manufacture, I need some amount of raw material put into it. The cost of that raw material varies with the number of units I manufacture, variable cost. Now, when we say sales value, for example, let us say the selling price of a unit of a particular product, one unit selling price is 10 rupees out there. My variable cost, that is the cost which varies with every unit I produce, is about 4 rupees, let us say. That means 10 rupees is the revenue, 4 rupees is the variable cost of that product. That means 10 minus 4, 6 rupees is what I call it as a contribution. Now, what is this contribution mean? Contribution means after covering the variable cost, after covering the specific cost of that product, whatever amount is remaining for covering the fixed cost out there. That is, every unit I manufacture and sell gives me 6 rupees for covering the fixed cost and yielding profit. Now let us assume my fixed cost is 10,000 rupees out there. Every unit I am manufacturing is giving me 6 rupees after covering its variable cost. So to cover 10,000 units, how many 6 rupees I have to earn? How many units I have to sell? So 10,000 divided by 6 will give you the number of units that you need to sell to earn the 10,000 rupees out. Now, that number of units is what we call it as a break-even point. That means if you manufacture so many units, you will make no loss and no profit out there. That is, that every unit which gives you 6 rupees after covering the variable cost will be exactly sufficient for you to cover the fixed cost out there. That is what we call it as a break-even point or break-even analysis. Am I with you now? Yeah. In this case, there is no profit and the company is just afloat. Yes, the break-even point is required for a company to know beyond which point, beyond which number of units they will start seeing profit. Supposing, let us say, that 10,000 divided by 6, can you just do it, Devang? What is number of units? 10,000 divided by 6. 10,000, I said 10,000 divided by 6. 10,000 is the fixed cost. I said 6 rupees is the 1666. If you look at 6 rupees is the contribution, that means 1,666 units if I manufacture, I will break even. 1,667th unit I manufacture. What is my profit? My profit is 6 rupees because fixed cost is completely covered. The entire contribution of that 667th unit is my profit. So I manufacture 2,000 units. That means 2,000 minus the break-even point of 1,666 into 9 rupees, because 6 rupees is the contribution, into 6 rupees is going to be my profit. The break-even point helps me decide beyond which point I will start making profit out. Am I with you now, Mrinal? Yeah. Any other question? Any other doubt? I can clarify. If you have questions, please feel free and ask me. With regard to the course, I can spend time in answering that. Can I explain cost pool with an example? Cost pool, I mean, can you be a little more specific, sir? In which context specifically? Yeah, definition. Oh, definition is perfectly fine. I mean, I have the definition also in front of me right here when we talk about the cost pool. It is basically when we talk about what do you call it as the cost pool out here, it is sort of what I call it as an arrangement where the costs incurred by any business, if you look at the costs incurred by any business, or even what is called as the individual departments or the services, etc., etc. What we look at is it is used in activity-based costing out there. That is when we are looking at to estimate the cost incurred. That is what we typically call it as the overhead. That is the grouped cost, the grouped cost out there, typical overhead cost out there. That is the cost pool that we use for what is called as segregating between various departments or service centers, or what you call it as even various products what you will manufacture and so on and so forth. So the cost pool is a aggregated cost, a combined cost which occurs for across departments or across products. So that cost pool, when we use for dividing that, that is what we call it as apportionment and assignment of cost and apportionment of cost. But when we say cost pool, it is normally a combined cost across various sector, various service departments or products out there. Yeah. Any other question, please?
Good evening, sir. Mukesh
Good
Wahi
evening,
here.
sir. Good evening. Yes, sir.
How are you, sir?
Good. Very good, sir. Very good. Very good, Mr. Mukesh. Yeah.
I'm fine, sir.
Yeah.
I had a bit of a struggle with that ABC system.
Okay.
Assigning various costs and how are the methods of assigning.
Yeah.
How important is it okay, all parts of this course are important, but how important it is for a person or for a participant or a learner actually absorb all of it? I'm thinking like, okay, if I have an overview, is it okay?
See, activity-based costing, I'm not even asking you to understand how we assign. Ms. Vinod Saxena, I'll come back to your question. I see in the chat box. Before that, let me address Mr. Mukesh's question. Now, what is the principle behind activity-based costing? The principle behind activity-based costing is assign the correct cost to the correct product. That is all what is the principle of activity-based costing. Now, traditionally, how was this cost being assigned? For example, I took the example of a factory shop floor rent. This was basically assigned based on the number of units produced by each, number of units of each products produced. For example, I produce 10,000 units of A and 5,000 units of B. I'll assign it in the ratio of 10:5. Or the value of those products, I'll assign it on the basis of that value. That is how traditionally these costs were being assigned. That is the common cost, what we call it as. Today, what we are trying to do is a little more scientific method of assigning cost. Scientific method of assigning cost is I will identify the activity that is driving me to incur that particular cost and then assign it on that basis. For example, I said shop floor rent. I will say which product occupies how much of space of the shop floor, and based on how much of floor space is occupied by the product of the shop floor, I will divide it on that particular basis. Very, very simple example I've given you. So that is activity based costing. The activity is the percentage of space occupied by each product. That is all what is the activity, and based on that I will decide. So now coming to the activity based costing is assigning the cost based on activity, based on the actual activity that is driving that cost out there. Now this is the theory part of it. Now second thing, how important is it? Knowledge of it, what is activity based costing is important. How does it assign? That is what I use a simple example to explain how is it, what is activity based costing. That knowledge is certainly essential. But in order to look at minute calculations of it, of assigning for each of the costs, at this stage, unless you are in the costing department, I don't think you have to get into the minor nuances of it, but a broader understanding of activity-based costing is sufficient for it. Have I answered, sir?
Right, sir. Thank you.
Yeah. Now, let me go to Mr. Manal Saxena. Yeah. Degree of leverage is irrespective of break-even analysis, only for sales analysis. Degree of leverage, I'm still trying to understand your question, sir. Degree of leverage is irrespective of, degree of leverage is irrespective. Degree of leverage means normally in finance, it's more leverage means the amount of debt component in your capital structure per se. Because when you're high, the firm is highly levered, means more and more of debt into the firm is there. That is where we call it a leverage. Degree of leverage, break-even analysis, very, very slightly, I would say, different. I mean, let us not confuse both together. Let's keep that as of now, let's keep that separate. Normally, when we say financial leverage, it's only what is called as the leverage means presence of borrowed money in the company, presence of borrowed money, borrowed capital in the capital structure of the firm out there is leverage. That is all. Now, break-even analysis is to do with the sales and production activity per se.
Right, sir. Wahi again.
Yeah.
I'm going back a bit. You use the indirect method of computation
Yeah.
versus the direct method of
Cash
computation.
flow statement. Yeah.
Cash flow statement. Yes, yes.
Yeah.
I have a similar question on this. How important is it to learn that indirect method?
Indirect
That
method
one
is
is a bit
what is,
tedious.
yeah, indirect method is a method that is always used. For example, if you look at any annual report, if you look at typically any annual report out there, and then look at the financial statements, there is a PF profit and loss statement, there is a balance sheet, and then there is a cash flow statement. That cash flow statement will be only in the indirect method. That will be derived from the profit and loss statement and the balance sheet out there. So that is what is in use out there, because direct method of arriving at a cash flow statement is nearly impossible out there. Very simple. A number of transactions in an organization might run to few hundreds, about 500 to 600 transactions in a day. So if you have to prepare the direct method of cash flow statement, out of these 500 to 600 transactions, I have to identify which are the transactions where cash is involved, group them together, and then not only for that day, for the entire year, imagine the number of transactions you will have, and then basically prepare a cash flow statement. Humanly impossible or extremely difficult, unless today, of course, your software systems take care of it. So most of it is only done by the indirect method.
Thank you for the clarification, sir. I understand now I have to spend more time and work and
Yeah,
put more
little. I
effort
mean,
into
I've
this.
used some 2, 3 examples out there. So I think that slowly you could pick up. Maybe you could watch the video again or something like that.
Yeah, I need to practice more, learn more.
Sure, sir. Sure, sir.
Right, sir.
The
Right.
conceptually you get it right, and then I think that is fine.
Now everywhere, we hear about AI.
Yeah.
So this must be also making its way, or it would have already have made its way into accounting and finance also.
Yeah. So yes. Of course, yes. Of course, yes. Of course, yes.
Now the thing is, if you listen to social media, everyone says you all just need to know the correct prompts, the correct platforms, and you can get all results.
Yeah.
But is it really so simple in accounting and finance?
For example, you want to analyze a financial statement. I will
Hmm.
use the correct prompts, and I can get the analysis. For example, now, in fact, right now, the whole of today, I am trying to learn how to use use the Perplexity Pro. In fact, that's what I've been trying to use. So
Hmm.
I'm trying to learn the correct prompts in Perplexity. That's again AI software. They will do the analysis and give me. I give the balance sheet. I ask them to do analysis. They will give me the proper analysis. Ask them analysis as per the creditor analysis. Analyze the capital structure. They will do that analysis and give me interpretation. They can give interpretation, but that will have need a little more human element in interpretation. To an extent, that interpretation can be taken. But for example, if I want to look at the future and predict what is the kind of price movement, etc., that needs a human element there. So there, I would say a little more development in AI has to happen. Or at this stage, I would say human interface is required.
It is not a shortcut.
Yeah, it is. It helps you. That's all. It helps you.
Yeah, unless you know the basics, you can't actually use AI.
True. Very true. Very true. Any other questions, sir? Any other question? Anybody else? I can take more questions. I think we still have half an hour more. But Mr. Manal, when you asked me that, I've been thinking about your question of even relating the what do you call it as the leverage and the break-even analysis, etc. I mean, leverage to break-even analysis, I would say we look at operating leverage. That's basically leading to fixed cost, and you get what is the kind of operating leverage in that particular case out there. That is how you look at it. But I think keep the operating leverage aside. I would say general leverage is debt part of it, and break-even analysis is independent of it. Any other question, please? Anybody else? Neeraja? Meghana? Yash? Now you'd be also be seeing the course is also picked up a little bit of pace, especially when we have started on corporate finance. The pace will be even more higher as compared to the pace of accounting. That is because financial accounting, I'm introducing people. So I have to be very, very slow. But by the time we reach corporate finance, the pace will be slightly higher.
Agreed, sir. In fact, I have to keep going back, rewinding and again seeing it, maybe 2 or 3 times. Specific thing. That is what I do to actually grasp concepts.
Because I'm under the assumption that the basic terminologies you are not allergic to. Number two is you would also picked up an interest to pick up more, learn more, etc. So that is the reason I kept the pace slightly higher toward the end of it.
And I'm sure it will just keep on increasing
No, it
going
will not.
forward.
It'll be at this pace, sir. Corporate finance, and
Right.
that's all. I'm not increased the pace further. Any other question? I'll wait for maybe another 10 minutes. If there are no other question, then I think I'll close the live session and we'll have one more after about 2 or 3 weeks from now. Yeah. Is conventional style of cost allocation still used or any other will be relevant? Conventional method is still used, sir, in many places. Slowly, there is a movement towards what we call it as activity-based costing out there. So the movement is slow, and conventional system is still in use. I'm not saying conventional system is not in use. Conventional system is still in use in many industries out there. Some of them are moved. For example, L&T has moved completely into activity-based costing and so on. Conventional system still does exist. You can type on chat box whatever response. Yeah. I think Devang has posted the operating leverage part of it out there. Leverage is related to finance and BEA to sales and production. BEA is also related to finance, sir. Break-even analysis is related to finance because the finance fellow has to know whether the product or the number of units you are manufacturing is profitable or not profitable. Of course, it's used by production team also or the sales team also. Degree of leverage in the sense of your capitalization leverage will certainly help us to determine how much of debt is there in the capital structure. If the degree of leverage or the leverage and the capital structure is very, very high, that specifically indicates there is a lot of debt component, the equity will be very risky. That is, there is a risk of equity holders will be very, very high. Their expected return is going to be very high, and so on and so forth. Yes, Devang has put a more specific definition out there. There are no questions. I'll close it by 6:45. It is 6:38 now. I'll wait for 7 more minutes. If there are questions, I will take it. Yes, Manal Saxena, I'm not able to hear. Are you? communicating something?
Sir, you had prescribed 3 textbooks
Yeah,
for this course.
yeah.
If at
Eh,
all
uh,
one should study one textbook first, which one could it be?
for accounting, I would recommend um, once that Anthony and Hawkins. Accounting,
Right.
both cost accounting and financial accounting, Anthony and Hawkins. Finance,
Correct.
Stephen Ross.
Okay. So that first one is accounting text and
Yeah,
cases. Yeah. Because all of these books are vast. So
yeah. And Stephen
it,
Ross finance textbook is very, very simple.
okay.
And you
Oh,
can read it like a novel.
okay.
So that will give you a complete understanding of finance. Corporate finance by Stephen Ross and Westerfield. Whatever.
So probably if I wanted to read, I'll read that one first
Yeah.
because it is the simplest.
Corporate finance by Ross, Stephen Ross. I'll just type it out. And I think there's a third author also, third or fourth author also will be there. But these are the two main. Corporate finance by Stephen Ross.
Right.
Any other query? Anybody else? I'll just hold for 3 more minutes. If there are no queries, yes. If there are queries, I can hold on till 7 or even 7:30. Not a problem.
So do you have any expectations from learners, from students?
Expectations in terms of my expectation is
Learning.
learning, yes. You should not be averse to terminologies of accounting and finance. This certainly course is certainly not going to make anybody an expert in finance and accounting. But when somebody says a balance sheet, a P&L statement, capital structure, you should not run away. The student should not run away who has done this course. They should be able to comfortably stand and at least listen or contribute a little bit. That is all what my expectations are. Very basic level of understanding.
Yeah, perfectly stated. Because uh, you know, I don't think I would hesitate to open the balance sheet of a company and to have a look at it. It's not
Yes.
going to sound Latin to me or seem Latin to me now.
That is all.
Definitely.
That is all. It should not be, I mean, the what do you call terminologies of capital structure, time value of money, discounting, what we talk about, a balance sheet, a cash flow statement. These should not deter a person. These should not, what do you call, intimidate a person now. I mean, if a finance guy comes and mentions these words just to scare you, you should be able to come on, stand up and say, yes, I know it, what it is. That is the kind of expectation what I have from this course, sir. Because this is a very basic course. This is not an advanced course. This is not going to make person expert. This is going to give some very basic knowledge. Beyond that, somebody can always take it up and look at becoming an expert in that. That's open.
In addition, this helps actually evaluate companies. Suppose you want to buy shares of a company,
Yeah,
either to the common practices, listening to a financial advisor or
yeah,
listening to some
yeah,
tape or
yeah,
thinking this stock is going up.
yeah.
But what we call as fundamental analysis of companies,
Yes,
where we have to understand the fundamentals of the company,
yeah.
this is very important.
Yes, this is also a fundamental. The kind of analysis we do is part of the fundamental analysis for a company. That is what it is.
Right, right. Reading the balance sheet and reading the
Yes,
ratios and all that.
yeah.
And
So
no company follows a uniform approach. All companies have a different kind of
different.
approach to
Yes, yes,
giving,
yes.
sharing their results.
Yeah, true, 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 true. Any other questions? Anything else? If there's no other question per se, we can sort of wind up. Maybe meet after around 2 weeks or so. 2 or 3 weeks, I think. 3 weeks. I think Devang will again put up. Yeah. I think I have one in the chat box question in the chat box. Final exam of this course will also contain numerics also. Yes, sir. The final exam will have 6 parts. Each part of the course, financial accounting, cost accounting, corporate finance. Each will have 2 parts. The entire thing will be objective, so don't worry about it. The first part of financial accounting will be very simple questions like theoretical questions. Second part of financial accounting will be some numericals. Same thing with cost accounting, same thing with corporate finance also. All the questions will be multiple choice questions.
And we are not supposed to use calculators.
I think because it's online, I think calculators may not be necessary because you can always do it in Excel if it's an
Hmm.
online thing.
Hmm.
Or calculators can be also be used if you are comfortable with it. That's all.
It's a 2-hour exam,
It's a 2 hour exam, sir. It's a 2 hour exam.
100 questions.
Not 100. I think I will have less than that. I can tell you what is the number of questions I sort of have planned this time. I'll give you the, what do you call it, as a structure of the exam itself. There'll be 120 minutes is the exam. Financial accounting, there'll be 6 questions of theory, another roughly about 10 questions of numericals, or 11 questions of numericals, I would say. Cost accounting, again, 6 questions of theory, objective type. Again, 12 questions of numericals. Same thing with the corporate finance also. So totally, with all the theory, numericals, everything put together, you will have about 53 questions, sir.
Okay.
So the theory, basic part of it, current liabilities is what? Choose one of the options. So that kind of a stuff. So the in every part there are 6 questions which are theory, very pure theory. So these 6 questions in every part should not take more than half a minute per question. So that is how it will go.
So in this assignments, this weekly assignment, so
Yeah.
far, I have seen it is all theoretical questions.
Theoretical. Some numerical will
So
also be there, sir.
will come. Okay,
Yeah.
right, right. Yeah, just to get an idea of what
Some
could be there.
numericals will also be there. Whereas in the last 3 assignments, I think we have some numericals also.
Yeah.
Okay, then, if there are no questions, I think I'll close the session now. If there are some questions, I'm open for it. Since there are nothing, I think I will close it. Maybe we'll meet after 3 weeks one more time. Okay. Thank you. Good night. Good evening.
Thank you again, sir, for your valuable time.
Thank you, sir. Thank you.
It was a pleasure speaking to you.
Thank you, sir. Thank you. Thank you.